Now, we've seen the recent performance of the mid-cap fund.
This has been one of the fund which has underperformed the market, and this underperformance is on the backdrop of very strong outperformances over the last 4 years.
So we have cut down on our allocation to IT. We have added to domestic names. We have reduced our cash allocation.
So can I say, that the worst is over?
So the whole philosophy of the house, look at value migration, look at structural stories, look at right allocation. We have made all those kind of changes.
Why was this change exactly?
January of 2025 till about Feb of 2026, the sectors which have outperformed have been largely value buy sectors: public sector, banks, metal, defense.
And last 3 months, there is brutal price correction in some of these stocks. So in itself, that gave us this chance to get it at a right price.
When can we see the recovery happening?
March was a very bad month because of the war, and this fund fell down relatively a lot more lower. This is the time you double your SIP. This is the time you do top up in your portfolio.
If someone has invested 100 rupees in the fund, now it has turned to 1,000. Why should investors take this into the stride, and 1 year of underperformance should not erode the compounding story? Hello and welcome to another podcast. Well, my name is Kshitij Anand, and we all know that market goes through cycles, phases of underperformance, sectoral rotations, as well as a change in strategy. Now, for investors, the difficult phase is especially at a time when the fund is going through its stage of underperformance. Now, to test is whether it's change in strategy, whether there are internal factors or external factors. To decode this, we have with us Akhil Chaturvedi as well as Mr. Ajay Khandelwal of Motilal Oswal AMC. Now, today specifically, we'll be talking about the mid-cap fund and the recent performance of the mid-cap fund. Thank you so much, Akhil and Ajay, for joining me today on this podcast. And Akhil, let me start off with you. Now, we've seen the recent performance of the mid-cap fund. Now, is the performance of the mid-cap fund can be attributed towards the change in strategy from growth to value phase? Is there something, or it is just the markets in general which is causing the performance of the fund?
Yeah, so thank you, Kshitij. I think it's a pertinent question for the viewers to understand that our mid-cap fund, first to begin with, is a fund which has now completed 12 years.
Right.
This fund was launched in Feb of 2014, and today we are in April of 2026.
Right.
And through the last 12 years, this fund has lived through all kind of market cycles, our own fund cycles, all kind of external shocks, internal shocks, whatever you can talk about.
Right.
And despite all of this, over 12 years, this fund has delivered a 20% plus compounded annualized return. And for those investors who have lived in this fund through all the cycles, would have basically multiplied their wealth by almost 10 times.
Absolutely.
Right. So this is what happens when you zoom out and look at the long picture.
Right.
Now, as you rightly said, over the last 12 months, this fund is one of the fund from our stable, not that all funds, but this has been one of the fund which has underperformed the market.
Sure.
Right. And this underperformance is on the backdrop of very strong outperformances over the last 4 years.
Yes.
In fact, if you look at financial year 2022, 23, 24, even 25,
right, for
4 years straight, this fund has done consistently very high outperformance. Right. Why this outperformance happened was obviously the fund manager has done extensive work to identify the right businesses, the right sectors, and these businesses have compounded over the last 4 year period, and it created enormous wealth.
Right.
Now, what has happened in the last 12 months more specifically is that, as you rightly mentioned, there has been a style rotation in the market. So from January of 2025 till about Feb of 2026, what we have seen is the sectors which have outperformed have been largely what we call as value buy sectors, such as public sector banks, public sector enterprises, largely value bucket, delivered some exceedingly great returns, upwards of 30-40%. Metals did very, very well in this period. Defense, auto, to some extent healthcare. These are some of the sectors which are defensive. Largely we put them in the value basket, right? Now, over the last 12 months or in this period I'm talking about, these are the baskets which did very good performance.
Right.
But we being growth investors were obviously absent from these spaces. Therefore we did not get the upside from the businesses which are part of value style of investing.
Sure.
As the audience would know and you would know that we are positioned as growth style managers, and we believe in investing in businesses which can double their profits over the next 3 to 5 years time frame.
Sure.
Now, what happens is that in market, as market goes through cycles, even various investing styles go through cycle, right?
Yes.
So, if you look at the same fund over the last 3 years, has outperformed the market, but over the last 1 year has underperformed the market, because over the last 3 years growth style has outperformed value style, but in the last 12 months value has outperformed growth. So this will always happen when you are investing in various mutual funds managed by various mutual fund managers. Each manager will have style of its own.
Yes.
And they will all go through, including us, we will go through cycles of very high performances, low performances. And as you live through 2 or 3 cycles over a period of 10 years or so, is where, the real compounding plays out.
Right.
So yes, largely it has been style rotation in the market. Markets have favored value style of sectors and stocks, and they have gone out of favor for the growth style stocks. That became one major reason for the underperformance of this particular fund. You can also say that since it had great outperformances, we went through a mean reversion. The performances are kind of cooling off.
Right.
You can also say that it is basically getting prepared for the next cycle.
Right.
And how we will play the next cycle, I'm sure Ajay will talk more. So, but yeah, this is what I would say.
Absolutely. Ajay, let me come to you. Akhil has actually, given us a good backdrop as to, if you zoom out, then there is, we have 12 years of outperformance. The wealth has actually grown 10 times. So that's a good part of it. And yes, in the past 12 months, the performance is not that great, but definitely, change in style is something which has happened. So can I say, that the worst is over, or the efforts that you've made has started to pay off?
Thanks. So coming to mid-cap fund, there are a few changes that we have done. So first is, our focus is always to bring best ideas which delivered highest growth. But as Akhil is talking about, certain sectors where because of external factors, I would say, generally the de-rating has happened. It's not that those companies have seen earning downgrade cycle.
Okay.
It's just that, for example, I'll give you IT example. IT. Now, across the globe, the capital is going towards the AI.
Yeah.
If you look at the mid-cap IT companies, their earning growth is still north of 15%, which is like 3x of industry growth. But we have understood that there is change that is happening and jury is still out. We have seen a couple of cycles, how during those two technological shifts, it took a couple of years, but Indian IT industry eventually got the earnings back. So this time, this was little more dramatic in terms of shift, because money is gone into certain stocks and geographies, which we did not expect that it will happen so fast. So we have cut down on our allocation to IT. And secondly, we have added to domestic names. We have added to certain industries which are, we believe, are more structured in nature. We have reduced our cash allocation. So the whole philosophy of the house, look at value migration, look at structural stories, look at right allocation. We have made all those kind of changes. So earning growth of the portfolio still next 1 or 2 years will clearly outperform the index earning. And I'll tell you, the index earning itself for mid-cap is pretty high. And even though mid-cap is a challenging category, and as Akhil was saying, last 1 year, there are only few sectors which have done well. But as a category, it is still delivered 20% kind of earning growth for last 5 years. And it is reflected, even the free float of the sector is even higher than that. So qualitatively, sector mid-cap as a category has become better. The balance sheets of these businesses have become better. And still, you have almost 1/3 of the mid-cap companies which are actually giving negative returns, and these are high cash flow generating companies. So I think mid cap as a category will do well, and clearly the changes that we have in our portfolio will reflect our earning conviction, and as generally it happens, stock prices follow earnings, so that will happen.
Absolutely. Now, Akhil, let me come to you. A very pertinent question. I'll take the cue from Ajay only, and if I'm an investor, next question which will come to my mind is the worst over? When can we see the recovery happening? Just like, we ask the management, okay, fine, when is the next cycle of earnings growth happening, right? So probably if you can give that perspective to investors as well, I think that'll be very important, and they'll take it to their heart.
Yeah, no, Sheetal. So according to me, I think this fund bottomed out somewhere in January or Feb of 2026.
Okay.
Like Ajay mentioned, we have been very proactive in making all the necessary changes in the portfolio, and we have seen the initial results coming out with the performance what has happened in the month of March, where this fund has actually, after a gap of 12 months, for the first month, outperformed the benchmark. And March was a very bad month because of the war. Markets actually fell down by about 12% or so, and this fund fell down relatively a lot more lower. April till date, as we speak, also we are seeing more days of alpha accrual than actually losing performance, right? So that's where I feel that with all the changes what has been made, newer sectors have got introduced, newer ideas have got introduced. Some of the stocks which were not in the right sentiment, we've exited them out. Some of the stocks on the valuation front, we have exited them out, and we have entered into new spaces. That is also helping us recover the fund. So I would say to all the existing investors that thank you for your patience. It's been a tough journey over the last 12 months, but your patience will pay out in the coming times. The worst is behind us. So stay put. For those investors who have been investing through SIPs, this is the best time to do SIP, because when the fund goes through a cycle of underperformance or bad performance, you are buying more units at a lower NAV. So the compounding will play out in the future. So the SIP investors should continue with their SIPs. And those who are looking at fresh mid-cap allocations, then I always believe in one thing, that when you are allocating into mutual funds, you should always look at great institutions, great fund managers with long-term track record, well-defined philosophy, good portfolio, and buy them in their worst time, because you're buying everything good at the best possible price when the fund is going through a cycle. So at least your buying part is happening at the lower levels. And as the fund then recovers and goes back into its journey of outperformance, those investors who take this opportunity will end up getting higher compounding than those who come after the returns are produced. So absolutely, to conclude, nothing to worry in the fund. The entire investment team, our leadership team, Ajay is a veteran fund manager. I think we have been very swift and very fast in taking action. The moment we realize that we are losing the steam, Ajay got inducted as a manager, and Ajay's track record in managing our large and mid cap fund, one of the most consistent funds, the small cap fund. I'm sure that wisdom and that maturity will play out in the mid cap fund as well. So I would say that chill pill and relax, nothing to worry.
Absolutely. Well, nothing to worry. That's the message coming in from Akhil. But so Ajay, let me come to you on that. So recently, what has happened is that the number of funds have actually gone up from 18 to now 27, if I'm not wrong. And from an investor point of view, it's always this thing which is coming at the back of his mind, that what is happening if I'm missing out on something? Is there information that has been withheld from me? So they're in that stage. So if you can help investors to understand why was this change in strategy and how it helps to protect their interest.
Right. So see, last 1 year, a lot of changes happened, and during that time, there are a lot of good opportunities that are presented. So, because price also was very attractive. See, we always pay attention to fundamentals and the price at what we are entering into. So in last 1 year, especially in last 3 months, if you look at a lot of sectors went through changes, and last 3 months, there is brutal price correction in some of these stocks.
Right, right.
So the themes that we were looking at,
sure,
and we were looking at reasonable price to enter, we actually found that opportunity. So in itself, that gave us this chance to get it at a right price.
Right.
We have added into certain new sectors. We have introduced few new names into
sure,
the fund. And these are all, again, very core to our philosophy sectors where we see value migration happening, structural stories, which will continue for next 3-5 years.
Okay.
They are in mid-cap space. Some of them are even in large cap. So, for example, we are running, say, 75 to 80% mid-cap, but we are even buying large caps into it. And gradually, we may look to build even small cap allocation, which right now is not there. So, this will be, again, a good diversified mid-cap focused fund with high earning growth conviction,
right,
and diversified across sectors. There's another change that we have done is that we are looking at our allocation also more closely now. So you can look at, you can expect, say, 2% to 6 to 7% kind of allocation.
Right.
Another change that we have done is that the cash levels have come down drastically because we believe market is very attractive. And you can expect, say, 2 to 3% kind of cash levels going forward because as Akhil was also saying, we are fairly constructive on market. So these are some of the changes that we have done.
Absolutely. Now, Akhil, very interesting point when you started off with the conversation, 12 years, 100 to 1,000. So if someone has invested 100 rupees in the fund, now it has turned to 1,000. Why should investors, should take this into the stride, and 1 year of underperformance should not erode the compounding story? That's the eighth wonder of the world, that what most investors say.
Again, I think, fortunately now that we have a 10-year plus of track record, and like I said in my opening comments that over the last 10 or 12 years, this fund has lived through everything you can think of.
Exactly, right.
We've gone through the demonetization event. We've been through the event when the long-term capital gains were introduced by Mr. Arun Jaitley then.
Right.
We have been through the COVID. We have been through all these wars, and including the Iran war, right? So it's been through all the tough phases.
Sure.
And it has come out of all the tough phases shining like a star, right? And over the last 12 years, I can tell you, there have been only 2 years when the fund did exceedingly bad, which was one in, I believe, in 2017, right, when the fund fell more than 10%. And the other event was 2025 last year, right, when the fund corrected by more than 10%. So on 12 years, it's only 2 years when your fund has given a negative return 10% more. Right. I also went inside and saw rolling return analysis because that gives a better picture of the average return of all the investors coming across the time period. What we have seen that any investor who has crossed a 5-year period in our mid-cap fund has never made any loss and has made an average return of about 16.5-17%. It would have gone up now in the last 30 days. Probably it would be 17-18%.
Sure.
On a 3-year basis, the probability of making a negative return was only 7%. And for 1-year investors, the probability of making money, and these are rolling returns,
that's right,
is being 17%. So 1 year obviously is very short. The results could be anything.
Right.
But worst is that the probability of losing would have been 17%. Right? 3-year investor, 7% chance of losing money. 5 year का तो पैसा lose हो ही नहीं रहा है. And the average return for 3 and 5 year has been pretty good. Right? So these periods of one year will happen. There will be few quarters which will go bad, few weeks will go bad. What one should look at is that is the portfolio manager proactively trying to arrest the issue and trying to position the portfolio once again to capture the future opportunities. Absolutely. Which is where all of us always say that do a lot of research and a lot of homework before you cut check towards any mutual funds. But once you have done that, then you should give at least a 10-year cycle to any fund manager. Right. And as you live through 2 cycles of any fund manager, like we have seen in the mid-cap fund, it's a 20% compounded return. By no mean it is a bad return. 10x is not bad.
No, absolutely.
And one thing I can tell you, the one of the very few investors who has lived through journey is our own promoter, Mr. Ramdev Agarwal.
Oh, absolutely.
Right? So he was one of the first investors in our mid-cap fund because As you all would know that we put 100% skin in the game. And I remember in this phase of 2014-15, they allocated almost 400-500 crores in this fund, which is today valued at 2,800 crores. They never pulled out in any of the phase when the fund did bad. At the same time, they never booked profit when the fund was doing very good. So they've just stayed put. So end of the day, I mean, that is one, proof in the pudding that, if you just invest and stay invested, irrespective of whether you are bought on tops or bottoms.
Exactly.
Over a 10-year cycle, it really will not matter. So just focus on, like I said, the manager, process, philosophy, portfolio, long-term track record. That should give you the comfort.
Absolutely. And in fact, as you rightly pointed out in the conversation, that the remedial measures have already been taken, and
absolutely,
and the initial bouts of volatility are gone, and the fund is now started to show outperformance.
Like Ajay said, we were lucky we were sitting on 25% cash. So we could very quickly deploy all the money into the fresh ideas we were thinking. We have diversified the sectoral exposure. We have reduced the concentration on one particular sector, which was the IT sector. We've added a lot of new ideas across sectors like fintech. We've added banks after a very long time. We've added a few banks. Again, we have a decent mix of 25% large cap and 75% mid cap. And the number of stocks itself has now gone up from 18 stocks at the bottom to today about 27 stocks. And we believe that 25 to 35 stock portfolio is good enough diversification. So we have done apart from stock selection, we have done a lot of work on risk management. Where Ajay is talking about the allocation strategy, and diversification strategy. So all those things are now in place, and like I said, that the initial signs are looking very promising, and I have no doubt that in the next few quarters, one will see better days, and we will very quickly, hopefully with God's grace, recover this 1 year
underperformance as well. Very absolutely. Ajay, let me come to you. If you can also take us through the fund allocation as to where the fund is allocating in terms of sectoral.
So I'll start with IT. We have though reduced the allocation, and now it's around 10-11%. So that is one decent change that we have made in the overall allocation. We have added to, I'll club manufacturing because there are different parts to it. Capital goods, defense, renewables and all. That is around 20-odd%. Then the domestic facing names, for example, the discretionary, premium consumption, staples, so those kind of names, and financials if I add. So these are the main sectors where we are placed. And then you have all these bottom-up ideas where, we see that singular events playing out for those companies. So that is the overall allocation. And as I said, it's a well-diversified portfolio now.
Exactly.
One thing what investors should pay attention to is that the underlying growth of the portfolio has not gone down. Even in the bad phase, the underlying growth did not come down. And when I'm talking about growth, I'm talking about the growth of the underlying businesses. Only thing what happened was the PE multiples got corrected. Right. So we believe that in the long run, growth is equal to return. So we have been accumulating earnings. It is not reflected in the price. So whenever market feels appropriate and it gives us our due valuation, this same earnings will actually reflect in price, and that will be the phase when you will see that sparkling. So as long as the earnings are there, right? And today the PE multiples have also become very, very attractive for the fund, right? So now you have quality. It's a great quality portfolio. You have high earnings growth, so the growth check is done, and you have the right price. So Q, G, and P, all three are in place for a better future. So coming back to then your question, what is a good time to invest? When everything is in place, this is the time you double your SIP. This is the time you do top up in your portfolio. This is the time new investors should look at. So the biggest mistake in terms of behavior, what most of us investors, all of us as investors do is that whenever we want to allocate money in mutual funds, what we do is basically go and just look at the top performing funds, irrespective whether it's a large cap, mid cap, small cap. Like today, for instance, I was on on your digital page, and I was just seeing the top performing mutual funds. Basically, they were all the Taiwan fund and Korea fund and emerging market fund, and these funds are getting massive collections also. Now, what is the sense of buying into something which has already delivered 30, 40, 50%? In case of all these emerging markets, it's like 100% return. That's gone behind you. You have to see what is the future opportunity. Where is the value in future? For that, you need to do research. For that, you need to hear what we are speaking. Right? And then take a call for something which will do well in the future and not what something has done well in the past. Right? So don't be judgmental basis these short painful periods, short painful underperformances. That time, like we say, markets are falling, you should be a buyer.
Exactly.
Right. Similarly, good mutual funds, when they are falling, become a buyer. Right. You have to follow the same behavior.
Yes, absolutely. Now, I'll just probably add one bit to it, and there's this term which is more popular now, the hockey stick approach.
Yes.
So, and right now probably we are in that U shape, and it's looking for a vertical climb.
On this channel, I would not want to give any kind of very, very high expectations.
But yes.
But usually we have seen it does happen. If something is battered down too much unnecessarily, then the recovery also is like a spring effect. You compress the spring too hard.
Right.
When you release it, it goes up very fast.
Very fast.
So it happens in markets also, right? You see, in the month of March, we saw, one-way correction. Although it was not a very deep correction, but we still saw 12-13% correction. And April till date, broadly you are back to the same levels, right? So very quickly it bounces back also, right? So it happens in markets, it happens in mutual fund portfolios, it happens in your own stock portfolios.
Okay, right, absolutely. Now, closing thoughts from you, Ajay. What is your message to investors?
So, mid cap as a category is growing faster. As I said, the quality of earning is very healthy. The balance sheets are at decadal low debt leverage. So you can expect that any kind of growth which requires capital is already available with these companies. A lot of these sectors are seeing tailwinds. If you look around, whether it is PLI, China Plus One, any of the new manufacturing, any consumer consumption structural change that is happening, a lot of that representation is there in mid-cap.
Right.
That, as I said, is captured into earnings. And Akhil used the term accumulated earning. I'm saying 2-3 years of earning roll has happened and multiples have come down.
Right.
So we don't see earning downgrade happening.
Okay.
Because the earning expectations now are fairly benign. And considering all this, I think everything is healthy from balance sheet to P&L to cash flow generation. We expect that the category will hold up well.
Okay.
And our portfolio is constructed that way that even if, the oil prices remain high, there is inflation that comes.
Right.
I think we have bucketed our portfolio that way that some of these challenges we'll be able to navigate in a better way.
Absolutely.
I would like to just add one more positive as a concluding remark on our mid-cap fund is that, what we have seen in the past is when the funds go through a bad phase, the redemptions go up, sales comes down, and therefore there's a liquidity event and you are actually selling your stocks more, and therefore it can have a price impact. Now this behavior shift has also happened somewhere, right? And what I have seen over the last 3 or 6 months, ever since this patch has come in, is that our gross inflows have not gone dramatically down.
Exactly.
Right? It would have gone down by 30-40%, but gross sales is very healthy. We have a very large SIP book, SIP book of almost 800 crores every month consistently. I mean, we are not seeing stoppages in the SIP book. And gross adjusted with redemptions, the net purchases also is positive. Like last month was about 500 odd crores. This month also we are positive. So despite this 1 year of underperformance, which a lot of people are getting worried about, there are some smart investors who are still buying, and there are even smarter investors who are not selling, and therefore this outcome. So if anybody anywhere is thinking that, oh, this fund is not performing, therefore they are selling and they are not getting more money, and therefore the fund will furthermore underperform.
Exactly.
Just thought I'll give you some numbers to suggest that there is no pressure. In fact, he is very happy because through the fall he is getting 800 crores SIP free cash flow, and he can judiciously invest wherever he wants to invest, right? So we don't have to sell something to buy something. It's basically the cash which is coming in every month. Right. It helps us rebalance the portfolio. So that's like I think it's a big positive.
Exactly.
One, credit to the investors who are participating, and a huge credit to all our distribution partners who still keep the faith. And therefore I feel that combination of whatever we have spoken,
right,
that we have been proactive.
Yeah.
We have seen Ajay, one of the best managers we have, take up the portfolio. We are not seeing any massive redemptions. We have seen very swift churn in the portfolio. That churn is now settled down.
Okay.
All the risk management things what we had to do in terms of diversifying the portfolio, adding more number of stocks, right, diversifying across sectors, managing the weights of the stocks.
Sure.
All of the risk management stuff is in place. So, right, so it's a perfect time for our smart opportunistic investors to continue
absolutely
and participate in a fund which comes with a stamp of 12 years and the counting begins. It continues, and I hope that through your podcast,
right,
investors existing as well as new will get a lot more conviction and confidence to continue their journey.
Absolutely.
Thank you for the opportunity.
So trust the discipline and stay put. That's the message coming in for Akhil as well as Ajay.
Absolutely.
Well, on that note, thank you so much for your time, gentlemen, and explaining to the investors what's really happening. Thank you so much for taking the time out.